All right. So the reason we're doing this is because you're going to notice a lot more than just the Thomas team on this call. I've invited a lot of people. And when we train people to be underwriters, when we replicate ourselves from one underwriter to another, what we fail to do is explain why. All right. So we're just going to go through the business entities real quick so you know what you are and are not looking for and the purpose of the businesses. And then we'll do a deep dive into some tax returns. And hopefully I can cover a lot, and also hopefully I don't go so deep that I lose you. So let's go ahead and get started. Okay, I'm just letting you know, this is not for jumbo courses. Okay, this is for conventional loans only. All right, and the guidelines do change, right? That's just a little disclaimer there. Okay, we already went over what we're going to cover, so I can skip this one. We can go right into Schedule Cs, okay? Most of us already know what a Schedule C is. It is a sole proprietorship, but I brought it up because every once in a while we see a weird one, and I brought an example of it. Well, I made an example of one. A Schedule C is established because it's the easiest to get started and the easiest to quit. Technically, just because they don't have a Schedule C in 2020, but they did in 2019, it doesn't actually mean the business doesn't exist anymore. It just means they didn't have any income or losses, so they don't legally have to file, right? Sole proprietorship, 100% liable, all right? That one owner, all of his personal assets can be obtained from his creditors, people that he owes. The partnership business is different, okay? It's a pass-through entity. It means that it doesn't pay taxes at all to the government. It passes through all of its gains, all of its losses to the partners, okay? It's known for having more than one partner, more than one person, more than one owner, and multiple partners, right? In accounting world, they say once you get 10 partners, start an S corp. It just gets too messy. Partners are not considered employees, and I'll show you that on the 1065. There is no W-2 cut to a partner unless he has no interest in the company, like a law firm or an accountant. They can have the title as partner, but they actually don't own anything, and then they're cut a W-2, okay? But for self-employment reasons, if you own the 1065, you are 50-50% partner, there's no W-2 for you. It's just a K-1, okay? Advantages, more resources, more investors, more cash flow. There's a difference between limited partners and general partners, but I don't see how that's gonna really matter in income world as far as self-employment. But I put it on the deck page for you to read later if you want more information. A C Corp, S Corp, excuse me, also known as a sub corp, is a business entity that files on 1120S. Can have 100 shareholders, okay? It's also a pass-through company. S Corp does not pay taxes. It passes through all gains or losses to its shareholders via a K-1 and sometimes a W-2, unlike a 1065, all right? So you can have a K-1 and a W-2, okay? Even though he's got a W-2, if he owns more than 25%, obviously he's still self-employed, 25% or more. Okay. It's got unlimited liability and some limited liability. It really depends on how many owners there are. If the creditors do go after them after their debts, basically it's split amongst the owners, that loss. So just for additional reading. Okay, a C Corp, a true C Corp, doesn't flow to tax returns, not their personal 1040s. You will never know it exists. Every person, shareholder, CFO, CEO, and a C Corp is considered an employee, okay? So the only thing you're looking for is a W-2, or if that C Corp owns, let's say, Coca-Cola, they might be issuing dividends, right? Which will come on a 1099 DIV. So you could be looking for dividend income, which will flow to Schedule B, or you could be looking for just waged earned, which is going to flow to page 1, line 7 of their personal returns. All right, so it's not a pass-through company at all. The corporation is fully responsible for all their tax, which is where you get double taxation from. The corporation is taxed, it cuts a W-2 to its employees, and they are also taxed. All right, why would you do this? Why in the world would you be double taxed? Because now you have an enormous amount of investors. You're selling those shares, you're gaining capital, right? So huge advantages and also huge taxes. So
you're typically only going to find this for like very big companies or companies that want to go public or something like that. Would you say that's true, Lori, from your experience, or have you seen smaller C Corps out there?
The C Corp advantage is really only for those that are publicly traded.
Yeah.
Okay, because the tax is so high and they're double taxed. So
right. It's pretty unique. It's pretty unique to find a smaller one.
Yeah, it's mainly for large corporations.
Okay.
It really is. I think I covered that. Okay, so that leads us to the DE. We call it the DE, okay? And I don't mean DE underwriter chums ID, okay? I mean a business that is disregarded as a business entity, okay? It is usually an LLC, all right? And there are literally no business tax returns, okay? And it flows to page 1 of the Schedule E as if it's a rental property, okay? So if you ever see Box Spring Incorporated, okay, not incorporated, Box Spring LLC, on page 1 as a rental, it's actually a limited liability entity that is not recognized as a business. And it's due to how much money they make, right? They can qualify to be disregarded as a business entity, and usually only has one owner. It's the only way to really get around it. So there's no business tax returns, and I'll show you what one looks like. There's no P&L, there's no balance sheet. He's putting on his personal returns because he qualified as being disregarded as a business entity. All right. So just quick overview. I don't want to bore you with all the accounting definitions, but in general, a Schedule C has no W-2s. Okay. If you see any salaries paid on a Schedule C, that's just somebody else you paid. All right. So his income is just the bottom line, Schedule C, line 31. That's it. We'll talk about add backs in a minute. 1065, there's no W-2s. All right, it's just a K1 unless he has no interest in the company. He's called a partner because he made partner in a firm. That's it. All right, and when that happens, you can go back and get a partnership agreement and it'll show he has no interest in the company. All right, he's just going to be cut a W-2 and possibly a bonus at the end of the year for profits made. All right. 1120S, now you might want a W-2. You might have a K1 and a W-2. I'll show you what that looks like. All right, a C Corp, W-2, possibly a 1099 DIV for dividends, right? Because Coca-Cola pays dividends. And disregarded business entity, no business tax returns, no K1s, no P&L, no balance sheet. Any questions there? Did I go too fast? All good? All right.
Lori, sorry, couldn't hit my mute button. Disregarded entity, can you dig into that just a little bit more for like, when will you see that? Why, like, so people claim that for tax purposes, but like what type of scenarios are you gonna see a disregarded entity in?
A disregarded entity, you're going to see an LLC, possibly an LLP, that is really, I'm not going to say holding an asset because it's not a holding company, but it has limited income. So you might see 25 grand, 50 grand, very small liabilities. An LLC, LLP, it's not going to have any employees. right?
Yeah.
It's not paying accountants. It's not paying advertising. It's just a real simple company. Wish I brought an example. Okay,
Lori,
I
could you
made-
confirm what the underwriter would condition on in that stage? Your slide says there's no P&L or balance sheet. Most commonly, we are being conditioned for a P&L. When we have a DE, would we still be conditioned for a P&L that basically just says $0, or can we get around that condition?
Okay, when I show you the Schedule E, what it looks like, I'll explain it further. But
Right, okay, keep going.
right now, if you see an LLC or an LLP showing on a personal Schedule E, page 1, like a rental property, there's nothing else to obtain. You're going to calculate it like a rental property. No joke. So and that's why we have some newer underwriters on this call also, right? Because it looks like a business, but it's not. It's been disregarded as a business. It's technically not a business entity. So he's put all his liabilities, all his expenses, all his gross receipts and profits on that Schedule E, and we're going to calculate it like a rental income. So no other documentation exists, not even a bank statement.
So let's say someone creates an entity that they use just for investment purposes, just to make an investment in something. Would that be an example of like a disregarded entity where I'm going to create an investment to limit my liability to invest money in something? And would that be an example of where someone would, because basically there's no income or really income or expense, you're just wanting to limit your liabilities. So you would make that investment through like say an LLC. So you'd have a single member LLC that you create. But because there's no employees, there's no expenses, there's no nothing, would that be something that would end up, could be a disregarded entity?
It depends. There are a lot of elements that have to be analyzed in order to be disregarded as a business entity.
Okay.
Would a day trader qualify? No, I don't think so. And
Okay.
yes, they do have income. They do have losses, but
Yeah.
they're reporting it all on page 1. So there is no further documentation.
So okay. All right. That's interesting. I've got an example of one right now, but I'm not going to take up any more time on it. So.
Okay. Well,
Yeah.
bring it to me. Bring it to me on the side. I'm more than happy to look at it.
Perfect.
Okay. Whoops. Skipped it. All right. That's where we left off. All right. And we're going to just look at a basic Schedule C. This is a sole proprietorship. No W-2s. This is the bottom line. This is all his income, everything and anything. And I made this one up to show you what I keep running into and what you should look at before you send us the Schedule C, because it can make or break your loan. Okay. Now, this is just Peter Pan tours at Neverland. All right. He made gross receipts, 85,000 minus costs, total gross income, 80,000. No big deal. He's got some depletion he can add back in, 57,000 at the end of the year, right? You're going to add back in that depletion. Okay. But on this particular Schedule C, there's 2 people. All right. And in the IRS world, all right, if you've got 2 people on a Schedule C, they did it wrong. Okay. The only time this is allowed is when it's husband and wife, but they are still required to file separate Schedule Cs, which is why we are always like, please send your tax returns to a CPA, right? So this happens all the time. When this happens, husband and wife put both their names on the Schedule C. Now we're going to split your income in half. If one of them isn't on the loan. Okay, so that's something you want to watch out. Peter and Patricia slap their names on the Schedule C. Is it illegal? No. Are we going to ask you for amended returns? No. But if Patricia's not on the loan, we're only going to give you 50% of this 57,000. All right. And we see it happening more and more because people want to save money. They want to do their own tax returns. I get it. But just watch out for that. Any questions on this? I've got the next page is literally the calculations, right? Line